Let's ask one of this country's top financial advisors. He is Richard Saperstein. He's founding principal and CIO of Treasury Partners, and he joins us now. Welcome back.
Thank you.
You surprised at the resiliency of this market?
Not at all.
Not at all?
Not at all. Stocks went from a PE of almost 23 in October to 19 and change 2 weeks ago. And it's important to look past this conflict to the underlying fundamentals that are in the economy. We're going to have the sixth consecutive quarter of double-digit earnings growth, record profits, record margins, and the stocks have become way more attractive now with the conflict, much like after Liberation Day last April.
Yeah, but I mean, it's easier to dial back tariffs than it is to just dial back what's been taking place in the Middle East, because part of that's not in the president's control in some respects at this point. None of that factors in. You're just playing it like you would play that. Look through it and focus on the fundamentals.
The fundamentals are what counts. So let me give you some numbers.
Okay.
All right. So if we go to the operating cash flows of the S&P 493, it's roughly 6% for the next 12 months, the estimate. If you look at where, let's say, Amazon and Microsoft are, they're 7 and 7.5%. So you can basically buy a large growing company at an operating cash flow greater than the overall S&P 493. And that ties into the PEG ratios. So if you look at the PE ratios to the growth rates of different sectors, if you look at the large cap tech right now, it's 1 to 1.5. If you look at it in Coke or let's say Kimberly-Clark or Procter & Gamble, it's 2.5 to 5. So you're paying way more in staples or in the 493 for growth than you are in large cap tech.
All right, so Goldman's Tony Pasquarello today, I feel like you guys are on the same wavelength. He said, I've spent much of the past 6 weeks trying to work out why the S&P was so resilient. Kind of the same kind of question I asked you. In that search, a few things came up again and again. Number one, the market never lost confidence in the underlying durability of the economy, right? You agree with that. In turn, earnings expectations trended higher. That ended up being the story, more so than what took place in the Middle East and what's been taking place, or the spike in oil prices. Until the fundamentals of earnings and the economy change, you just were not going to change.
No, because the conflict ultimately will have a resolution. It's not going to go on forever. And the economy is benefiting from this surge in CapEx, favorable employment. Think about it. 300,000 government jobs were lost, and they've been absorbed into the private sector. So a privatization of the labor market. We've got deregulation, ease of permitting. There's a host of factors that are going to lead to rising profits and earnings. And stocks follow earnings in the long run. They don't follow the conflicts that are going on around the world.
So this plays right into something that you've been doing. You added 2 mega cap tech, Alphabet, Amazon, and Microsoft.
Yeah, I think
just thought the multiples had compressed and they were too attractive to pass up at these levels?
There are companies you date and companies you marry. And when these companies that you want to get married to go down and their operating cash flows and earnings keep going up, you want to add to them. And they suffered from a couple of hits in the last 60 days, whether it was the fact that they're spending all their operating cash flows on CapEx, or a host of factors that have affected large cap tech. Great opportunity to add.
What about the idea that multiples have come in, right? So you already knew that you were going to get durable earnings growth, right? Better than most other areas of the market. The AI spend doesn't appear to be slowing down anytime soon. And now you can get, slightly above a market multiple for most of these names, rather than a little bit more of a premium like you had to do before. It all plays in the story, right?
It does. And you can also buy them. The market multiple might be elevated, but the PEG ratio is below the 493, and the operating cash flow is above the 493. So while the PE might be higher, the growth rate is expected to be higher. The market's basically saying, hey, look, guys, you're spending all your operating cash flow on CapEx. We're discounting that. We don't believe in that. All right? I take the other view. I think that these CEOs know their market, know their business, and they're deploying capital efficiently, and it's going to benefit shareholders.
You must think that software's bottomed if you initiated small positions in Palo Alto and CrowdStrike. Is that right?
It's probably like catching a falling knife, which I don't like to do. I just wanted to get my feet wet, so I added a very small position. But I do think that there are certain software companies with embedded books of record, proprietary data, regulatory requirements, transactional records that are going to thrive because they're going to adopt AI, and they're going to actually benefit when all this is said and done. I don't see an AI agent coming in and disrupting these software providers that are in the stack of a company.
But you're tactical, though. I mean, you're looking obviously at cyber as a place that you don't think is going to be disrupted as much as the stocks would have suggested they would be, because Anthropic, every time Anthropic was in a sentence, the software stocks and these things went down a lot.
Exactly. And I also added Booking and Expedia because, like, the world is not going to stop traveling. Remember, the underlying economic condition of the country is fine. People are going to resume traveling, and those stocks are selling at very high operating cash flows, which is what I like.
Okay. Well, we'll talk to you soon. Thanks for sharing the knowledge. Rich Saperstein. We'll see you soon.